Welcome back to What's Hot, What's Not CRE, your daily pulse on commercial real estate in America. It's Thursday, January 29th, 2026. Today we're comparing Class A, B, and C multifamily, and there's a clear winner for 2026. So let's jump right in. What's hot? In a word, workforce. Class B multifamily housing is absolutely dominating the landscape as we move through the first quarter. The numbers don't lie. National Class B occupancy is currently sitting at 95.8%. Now, that might sound close to Class A's 95.7%, but the key difference is stability. Class B is holding stronger, weathering economic headwinds far better than its luxury counterpart. Why? It's all about rent growth and demand. Think about it. The price gap between Class A and B is significant. This gives Class B operators much more room to push rents with less resistance from tenants. They're not competing with a fire hose of new supply and hefty concessions. This is steady, organic growth, and the demand is structural, not cyclical. The shortage of affordable Class B and C workforce housing in this country remains acute. We simply do not have enough of it. This isn't a temporary trend. It's a fundamental market imbalance. Because of this, capital is flocking to the value-add Class B strategy. The promise of stable cash flows, combined with the opportunity to modestly upgrade units and capture that rent growth, makes it a central pillar for any income-oriented strategy in 2026. We're seeing this play out regionally, with the Northeast Class B market posting 4 to 5% rent growth, and the Midwest holding steady at a very healthy 3 to 4.5%. The Mortgage Bankers Association is forecasting a staggering $419 billion in new multifamily loans for 2026. A huge chunk of that is going to be targeting workforce housing. The smart money knows where the durable demand is. Now for what's not. And this won't be a surprise to anyone listening. It's Class A multifamily in oversupplied markets. Specifically, the Sun Belt. Markets like Phoenix are facing incredibly deep concessions. In fact, Phoenix currently has the highest concession rate in the entire country. We're talking 2, sometimes 3 months of free rent just to get heads in beds. It's a race to the bottom, and the pain isn't over. There are still about 500,000 new units, mostly Class A, that are in lease-up from the 2025 delivery pipeline. That supply needs to be absorbed. So markets like Austin, Phoenix, Raleigh, and Orlando will remain challenged, likely through the end of this year, if not into early 2027. The real danger here is that these massive concessions are masking the true rent performance. It's artificially inflating valuations and creating significant risk, particularly for properties financed with CMBS debt. It's a house of cards. Finally, let's touch on Class C. This one is a mixed bag for 2026. On one hand, operators are facing a serious margin squeeze from rent limits in some jurisdictions, coupled with soaring insurance and maintenance costs. Older, unrenovated Class C properties are struggling as renters, even at lower price points, now have more options in better located Class B buildings. However, it's not all bad news. Affordable, well-located Class C assets are still benefiting from that same structural workforce demand we talked about. If the building is in the right place and managed well, it can still perform. So why does all this matter? It paints a very clear picture of the multifamily landscape. Class B is truly the Goldilocks zone right now. Strong cash flows, affordable rents for tenants, and manageable operational pressures. It's the sweet spot. A full recovery for Class A simply won't happen until that mountain of new supply gets absorbed, which, being realistic, is likely late 2026 at the absolute earliest. As a result, institutional capital is heavily favoring proven sponsors who specialize in Class B value-add deals. So for our investor takeaway today, the 2026 playbook is clear. Class B workforce housing is the strongest play. Durable demand, manageable expense pressure, and capital access. Class A in oversupplied Sunbelt markets is weakest. Avoid until concessions burn off late 2026. Class C can work, but only with hands-on management. Thanks for tuning in. See you tomorrow. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.